What does a viewer do? What does an individual do right now? Would it be safer to go after fixed income? The rate cycle, of course, is expected to soften, but we haven't seen it just yet.
Yeah. I think the way economy is panning out, where growth has seen a dip over the last 4 quarters, and everybody was expecting an interest rate to be cut yesterday by RBI, which has not happened. But if you look at, I think in an economy like ours, which is basically facing a prospect of lower growth, cut in interest rates is an eventuality. You cannot time it, because I think RBI has to, in any case, maintain that fine balance between inflation and growth, and therefore when they see that cutting in interest rates will not result into higher inflation is the time when they will start cutting interest rates. But cutting of interest rates is an eventuality, because that's a very potent mechanism to spur growth and investments in the economy. And therefore fixed income investments, especially mutual funds, can actually play a big role into investors' portfolio in generating better returns at this point in time. So investors can actually put a portion of their fixed income investments into long-term debt funds and dynamic bond funds of mutual funds, which actually play down the price cycle. So when interest rates go down, the prices of the bonds go up, and therefore investors in the next 1 or 2 years can earn higher return than the inherent yield of the investment.
So just very quickly, if you can tell me the products that would be most suitable in an environment where you would see easing of the rate cycle.
So these are typically long-term debt funds. So if I have to name a few, let's say an HDFC has an HDFC income fund.
Can you tell us a little bit more about long-term debt funds?
So long-term debt funds invest,
the features of them, the key features.
Long-term debt funds invest in a basket of securities of varying degree of maturities.
Okay.
So typically any long-term debt fund will have around 45-50% into government securities, and another 30 to 40% into PSU bonds, and the balance into corporate papers.
So that balances out the impact of the rate
cycle. Then they basically play on the average maturity of the total portfolio, and therefore try and benefit from the fluctuation in the interest rates. So when the interest rates are likely to go down, they'll reduce the average maturity. So the yield will actually, you'll get the current yield of the portfolio. And when the interest rates are going down, they will elongate the average maturity of the portfolio, so that when the interest rates actually go down, you have some price gains as well, besides the current yield. So typically in an environment, if let's say a thumb rule is that if the duration of the portfolio is 7 years and interest rates fall down by 1%, you can actually get 7% extra return. So you can get around 15% return if the interest rates fall by 1%.
In your opinion, which are the most popular long-term debt funds that investors can look at?
There are some. There are a lot of debt funds. In fact, every AMC has an long-term debt fund typically, and the more popular ones are Reliance Income Fund, HDFC Income Fund, Birla Income Plus, SBI Dynamic Bond Fund, IDFC Dynamic Bond Fund. So these are the ones which are more popular than others. But every AMC has a long-term debt fund, and they are managed well, typically, I've seen.
Right. Mahendra, also we've talked about all the positives of fixed income products. What is the negatives, apart from restricted amount of returns, or your upside is capped?
I think the biggest negative in fixed income, as I was saying earlier, is that the credit risk. And many people, we have seen companies from AAA becoming D. Overnight, and therefore defaulting, and therefore investors don't get money in such scenarios. Their money, they don't get their money back. There have been cases where banks have actually gone down. There have been cases where cooperative banks have been sealed by RBI because they were not working well. And so that's the biggest risk of any fixed income investment. Will I get my money back when it's due? And that's what investors should look for when he's investing into fixed income, that his credit quality is not sacrificed.
That of course brings me to my next question. With the amount of uncertainty that we're seeing, it's very difficult to take a call even on a fund. So you might invest in a given fund, ratings in a couple of months would change. What happens when that happens? Because of course, when you've invested in it, it could be a AAA rated company or a AAA rated bond or fund. But what if the situation changes because of the global uncertainty? That, I guess, makes a lot of people very apprehensive to go out there and make those investments, right?
That's right. You're very right, in fact, and therefore, when you are getting into the private sector, it's better to go through a mutual fund, because that fund has experts to look at credit rating on a proactive basis. But if you are not an expert yourself, then probably restricting yourself to bank and post office is the best solution.
Right. and that's of course advice coming in, and of course more insight into what fixed income products are, what their features are, and of course what you should be doing if you're looking to plan your finances in the current environment. We'll take a break, we'll come back and take up all your financial planning related queries.
The Financial Planner, presented by BSC Investors Protection Fund. Planner, presented by BSC Investors Protection Fund.
Welcome back. You're watching Financial Planner. It's now time to take up all your financial planning related queries.
Investment Ladder, presented by BSC Investors Protection Fund.
Raghavendra, we've got a query from a gentleman called Nitin Shetty. He writes in to us with his portfolio. So he's got a few investments in HDFC Top 200, SPI, Franklin, and DSP BlackRock. This is, of course, I think his goal is retirement planning, so he makes that 15,000 rupees of investment every month, and of course his son's education, which is about 5,000 rupees a month. He's 34 years of age, and it's been about 4 months that he started making these investments. He says in addition to what he's already doing, he wants to add another 10,000 rupees in a debt fund and gold ETF. What's your advice?
Yeah, I think looking at his age and the way he's doing investments, I think he's on the right track. In fact, we were doing certain analysis and we figured out that if he's investing this 15,000 rupees and keep on adding 10% to it every year, in the next 25 years, he'll have something like 3 crore of rupees with him.
For his retirement,
okay. Which is a very healthy amount, you know. Okay. And for the monthly SIP of 5,000 that he has started for his son will also give him something like 25 lakh rupees to 30 lakh rupees in the next 12, 13 years. And therefore, which should prove sufficient for him to basically provide a good education to his son. As far as his debt investment is concerned, what our view is that, you know, looking at his income profile and the kind of investments that he's making, he'll be better off investing in fixed deposits and PPF rather than a debt fund.
Okay.
And so my advice will be that out of this 10,000 rupees, probably 5,000 rupees every month, he can start investing in a PPF account, which gives him tax-free income, and that's logged in investment for 7 years minimum and 15 years in all. So I think he'll basically not have he'll create a decent amount of pile of money over the next 15 years. And the balance 5,000 rupees can go towards fixed income fixed deposits in banks, where he will also have liquidity in terms of, you know, spending that money if there is any need for him.
What about gold? He also wants to know, is gold, should he be investing in a gold ETF? It's not required because he's already doing fixed income.
Yes, no, he can do gold ETF, but I think it should be more from a consumption perspective. Let's say people have, you know, requirement for gold in marriages, for his son's marriage or his daughter's marriage, if he requires some gold, he can build that bit by bit, investing in a gold ETF. That's the right thing to do.
Raghavendra, what are you making of his portfolio right now? He's got 4 mutual funds that he invests in every month.
That's right.
Are they good enough?
I think all the schemes are pretty good, in fact, and I won't suggest any change in them, you know, so he can just continue with the same schemes.
Right, that's the advice.
He has the adequate amount of diversification as well.
Right, that's the advice coming in for you, Nitin. We've also got another query from Rupesh Shah, who says he'd like to invest for the long term through SIP by investing lump sum in a debt fund and then doing an STP. Which of these is better, HDFC Flex STP or Reliance Smart Step? If both are good, then can he also invest through both, or none of them are good?
Yeah, in fact, STP is a very smart way of investing into equities, and a lot of people come across lump sums of money, you know, when they get annual incentives or annual bonuses, or they get some inheritance or a gift. They get lump sum money, and therefore, you know, if they have to invest into equity, probably doing an STP makes more sense than investing that entire money in one go, because then you can ride the volatility of the stock market as well. So STP is a very smart way of investing, and so he has chosen the right way of investing. The only suggestion is that, in fact, every mutual fund has a systematic transfer plan. So he should be more focused on the equity schemes that he's choosing rather than looking at the STP. You know, so every mutual fund has an STP plan available with them. So he should choose a good basket of 3 or 4 funds. So like in HDFC, he can probably go for HDFC Small and Mid Cap Fund, which is doing very well. In Reliance Equity Opportunity is doing well. Besides that, he can also choose 2 other funds, let's say an ICICI Focus Blue Chip, SBI Emerging Businesses Fund. So these 4 funds he can choose, put money into their short-term debt funds, and from there he can do an STP.
Right. Rupesh, that's the advice coming in for you. Raghavendra clearly saying that investing through the STP route is actually advisable. And of course, he also recommends a couple of funds that you can look at where you can make those investments. We'll take a quick break. We'll come back and continue taking up your queries.
The Financial Planner, presented by BSC, Investors Protection Firm.
Welcome back. You're watching Financial Planner. Raghavendra, of course, we ran out of time to take up any more queries on this edition of Financial Planner. But very quickly, I just want you to sum up this whole fixed income products for me and tell our viewers very quickly what your take is on the whole asset class.
See, Samina, fixed income is an extremely important portion of any asset allocation that investors are doing. And therefore, every investor should have some amount of fixed income investments in his portfolio, however aggressive they may be. And I find a lot of equity traders who don't have any investment into fixed deposits because they think that, 8% is nothing or 10% is nothing. But I think they should think about their families and then invest into that fixed income, which is an assured return over a period of time, and whatever said and done, even at 10% return, your money doubles in 7 years, and in 14 years it will be actually 4 times. So money definitely grows, and it also keeps pace with inflation. So fixed income is a very good investment. The only thing is people need to have a balance of all asset classes in their portfolio. So conservative investors can have a higher fixed income, but they should not ignore equity. And aggressive investors should have lesser fixed income despite they being aggressive.
And as you get closer to your goals, should you sort of switch and rebalance your portfolio more towards fixed income products because it provides assurance?
Yes.
Also, very quickly, if you've got a contingency fund, which I know a lot of financial experts advise individuals to do, can that contingency fund be held, or that amount of contingency fund be held in terms of a fixed income product?
Yeah, why not? In fact, see, today banks gave a very good facility of breaking fixed deposits into small parts. So if you have a lakh of rupees that you have kept away for contingency, probably you can distribute into 20 fixed deposits of 5,000 rupees each. And even so your entire money is earning returns, but if you have to withdraw 10,000 rupees, then only the 10,000 gets affected and gets lesser return, but the 90,000 continues to earn higher return.
Investment Ladder, presented by BSC, Investors Protection Fund.
Right, thanks so much, Raghavendra, for that. That's, of course, more details on coming in on fixed income products and why you should be considering investing in those. That's all the time we have on this edition of Financial Planner. Thanks for watching.
The Financial Planner, presented by BSC, Investors Protection Fund.